Following a year of strong returns, fixed income markets head into 2026 with both solid momentum and a new set of challenges. Hello, I'm Sara Devereux. In this video, I'll break down the forces shaping fixed income markets and the key themes our teams are navigating. First, elevated starting yields provided a powerful source of income. We entered the year with historically attractive starting yields across treasuries and credit sectors, a continuation of the new era that began in 2023. Those yields set the stage for strong income returns. Second, fixed income delivered critical ballast to portfolios. In April, equity markets stumbled on tariff concerns, with the S&P 500 down nearly 5% year-to-date and roughly 19% off its peak. Finally, bond price appreciation drove strong total returns. Yields moved lower during 2025 as inflation moderated from pandemic-era highs and the labor market cooled. This allowed the Federal Reserve to lower their policy rate by 75 basis points. The front end and intermediate parts of the Treasury curve rallied, adding price return on top of income. In credit, strong corporate fundamentals and investor demand helped keep investment-grade and high-yield spreads near multi-decade tights. Municipal bonds recovered from a challenging start to the year marked by heavy supply, outperforming the taxable market in the second half of the year. We expect 2026 to be another compelling year for fixed income. With yields remaining high, investors don't need a rally in rates or credit to generate an attractive return. While recent rate cuts have driven yields down on cash investments, a steeper yield curve rewards investors who extend duration and move further out along the curve. Our base case for the U.S. economy is for trend growth, supported by robust AI-driven capital investment. This environment is generally supportive of risk assets, but valuations are lofty and crosswinds abound, creating both risk and opportunity. That's why we believe it's important to build resilient portfolios that perform across scenarios. Fixed income remains a strategic stabilizer, offering attractive income and acting as insurance against a weaker growth scenario, especially as labor markets recalibrate and policy uncertainty persists. Key themes we're watching include, first, AI's impact on the economy and the bond market. Continued growth of AI investment is a key driver of our expectation for stronger growth in 2026. While most of this investment to date has been self-funded from free cash flow, many of these firms are now tapping the bond market to finance growth through a range of structures. Second, the emerging cracks in credit. Recent developments in private credit don't appear systemic at this stage, but we are monitoring closely. Spreads remain tight, leaving little cushion against stress. In this environment, rigorous due diligence is more critical than ever. Third, policy crosswinds. The impact of tariffs has been building, but in 2026, we expect their impact to be offset by fiscal support and deregulation. Term premium remains a watch point, particularly with the focus on affordability and the K-shaped economy. The Fed is divided, and while we expect limited further Fed easing, they have indicated that there is no risk-free path. And finally, technicals. Supply from CapEx is strong, but we expect it to be easily absorbed by robust investor demand for fixed income, particularly as steeper curve rewards investors who extend duration. There's an incredibly rich opportunity set for bond investors today, and our active teams are excited by the pockets of value they have been finding across sectors. The bond market isn't simple. It is inherently complex, vast, and opaque, with more than 30,000 CUSIPs in the global ag, and much of the market trading over the counter. This complexity can be a barrier for some investors, but it creates powerful opportunity for our highly skilled managers. Recently, volatility has amplified these opportunities. While this volatility creates risk, it also drives dispersion in valuations, dispersion that our teams can monetize. 2026 will be a year where discipline and precision matter more than ever. With spreads near multi-decade tights, broad-based tightening is less likely, Instead, we expect to see increased dispersion as winners and losers emerge and policy shifts play out. This is an environment where security selection will be critical. Not all boats will rise with the tide.